OneMain Holdings, Inc., OMF, presents a distinctive value proposition within the specialized consumer finance sector characterized by a deep valuation discount that appears to misprice its robust capital generation capacity and effective management of credit risk through the current economic cycle. The investment thesis posits that OMF's core strengths, specifically its high-yielding, diversified non-prime loan portfolio and its demonstrated commitment to shareholder returns, are undervalued, particularly given the recent stabilization and improvement in key credit metrics. The firm's stock is priced with forward earnings multiples that are markedly low, accompanied by a sector-leading dividend yield of 6.82%. This discrepancy suggests the market is applying a substantial risk premium, reflecting historical volatility inherent to non-prime lending and ongoing regulatory uncertainties. The most critical long-term catalyst capable of fundamentally re-rating OMF's equity is the potential successful acquisition of an industrial loan company (ILC) banking charter. Such a license would dramatically alter the company's financial structure by allowing it to shift from expensive, cyclical wholesale funding toward lower-cost insured deposits. This transformation promises a permanent expansion of the net interest margin (NIM) and would justify a sustainable valuation multiple closer to traditional regulated banking peers. Near-term momentum is driven by the continued expansion of managed receivables, which reached a record $25.9 billion in the third quarter of 2025, Q3 2025, and the sustained trend toward credit quality normalization, evidenced by year-over-year declines in net charge-off rates. Principal risks are concentrated in macroeconomic and regulatory domains. OMF's business model is acutely sensitive to cyclical downturns, as its non-prime borrower base is the first to experience default during periods of financial stress. The second material vulnerability stems from the ILC application itself, which faces vigorous opposition from consumer advocacy groups concerned about the potential erosion of state consumer protection laws and exemptions from requirements such as the Community Reinvestment Act, CRA. The protracted nature of this regulatory friction introduces significant timeline and outcome risk, serving as a primary constraint on multiple expansion. The strategic context, business model, and regulatory outlook. Core business model, growth, and market positioning. OneMain Holdings operates primarily through its consumer and insurance C&I segment, providing installment loans to non-prime consumers. The business relies on an extensive, often branch-based distribution network, allowing for direct underwriting and collateral management. This operational structure grants OMF a qualitative advantage over purely digital competitors in assessing and mitigating risk in the subprime space. OMF has demonstrated persistent market share gains and asset growth despite a challenging macroeconomic environment. Managed receivables have expanded substantially, achieving $25.9 billion in Q3 2025. Management is strategically diversifying the portfolio, enhancing debt consolidation products, and expanding into card and auto lending, utilizing automation to drive efficiency improvements. The ongoing commitment to high-quality loan origination is critical, as management has noted opportunities to write higher credit quality loans while the credit environment moves toward more normalized levels. The ILC charter, funding transformation and regulatory conflict. The most profound long-term strategic initiative for OMF is its application for an industrial loan company, ILC, bank charter. The rationale for this move is purely structural and financial, achieving a lower, more stable cost of funds by sourcing capital through insured deposits rather than relying solely on the more expensive and volatile commercial funding markets. Obtaining the charter would also streamline compliance by allowing OMF to adopt a nationwide rate structure. However, the ILC application has become a focal point of regulatory conflict. Consumer protection groups strongly oppose the application, raising concerns that if granted, the bank charter would exempt OMF from critical state consumer protection measures, including all-in 36% annual percentage rate APR caps, such as the Illinois Predatory Loan Prevention Act, PLPA. Opponents argue that granting the charter would enable the resumption of high-cost lending activities by evading strong anti-evasion language in state laws. Furthermore, the ILC structure is often viewed as less stringent because it is exempt from the Community Reinvestment Act, CRA, which mandates equitable financial systems serving all communities. The decision hinges on the fundamental conflict between OMF seeking operational efficiency and consumer advocates framing the move as regulatory arbitrage. Regulatory bodies must assess the safety and soundness of a high-risk lending model, non-prime, supported by lower-cost federally insured deposits. A delay or denial of the charter would ensure OMF remains reliant on more costly wholesale funding, maintaining the existing structural disadvantage relative to traditional banks, and perpetuating the current valuation discount. Macroeconomic and credit environment review. The operating environment for consumer lenders remains mixed. Aggregate household debt balances increased by 1% in Q3 2025, reaching $18.59 trillion. However, underlying indicators point to continued financial strain, particularly in OMF's target market. For example, student loan delinquency rates were high in July 2025, 21% for non-deferred loans, alongside an uptick in revolving and auto loan delinquency. This financial stress, especially among subprime borrowers, validates the market's demand for a high-risk premium. Notwithstanding these sector-wide pressures, OMF has successfully managed its internal credit quality metrics. The company's focus on selective underwriting, portfolio seasoning, and expansion into secured products has created a favorable internal credit trend that runs counter to broader industry concerns. The consumer and insurance segment's 90-plus days delinquency ratio fell year-over-year to 2.35% in Q3 2025, down from 2.49% in Q3 2024. The simultaneous presence of internal credit stabilization and external consumer distress suggests that OMF's strategy of prioritizing higher credit quality originations is effectively insulating the portfolio, driving positive earnings surprises by reducing the necessary volume of provisioning. Income statement analysis, growth, yield, and profitability drivers. The income statement demonstrates substantial momentum in core earnings, driven by receivable expansion and reduced credit provisioning risk. The primary component of OMF's revenue is net interest income, NII, derived mainly from the consumer and insurance segment. Net interest income dynamics. For the full fiscal year 2023, OMF generated NII of $3.545 billion, resulting from $4.564 billion in interest income, offset by $1.019 billion in interest expense. Recent quarterly results show strong NII expansion, rising sequentially from $1,002 million in the fourth quarter of 2024 to $1,066 million in Q3 2025. Management attributed the strong NII growth in Q3 25 to a dual tailwind, the substantial expansion in managed receivables, reaching $25.9 billion, and an improved portfolio yield. While this growth is highly favorable, it was partially offset by an increase in interest expense. This higher expense was necessitated by the greater volume of average debt required to finance the accelerating growth of the receivables portfolio. The challenge remains managing the cost of this debt within the current high-rate environment, a vulnerability that the ILC charter is intended to address. Credit loss provisioning and realized losses. The most significant lever for profitability in non-prime lending is the management of credit losses. The provision for finance receivable losses has shown a favorable trend in 2025. After peaking at $523 million in Q4 2024, the provision stabilized, registering $488 million in Q3 2025. This stabilization suggests that management's forward-looking loss estimates under the current expected credit losses accounting standard are improving, reflecting greater confidence in the quality of the portfolio. This provisioning trend is firmly supported by the decline in realized losses. The annualized net charge-off rate, NCO, fell to 6.67% in Q3 2025. This represents a material year-over-year improvement, down from 7.43% in the prior year quarter, Q3 2024. It is also substantially lower than the full year 2024 NCO rate of 8.12. This synchronization, where higher yields and volume drive top-line growth, NII, while effective credit management drives down the cost of risk, provisioning, is the primary factor behind the robust 2025 earnings performance. If this stabilization continues, it indicates that the underwriting vintage quality has improved, reducing the inherent drag associated with portfolio seasoning. Earnings and profitability. The strength in NII and provision moderation translated directly to robust earnings growth. OMF reported GAAP net income of $199 million for Q3 2025, which corresponds to GAAP diluted EPS of $1.67. This represented a 27.5% increase over the $1.31 EPS reported in Q3 2024. Management often emphasizes a non-GAAP metric referred to as capital generation, based on C&I adjusted net income. The adjusted diluted EPS for Q3 2025 was $1.90. The preference for this adjusted metric underscores the company's belief that core lending and insurance profitability is the most reliable measure of long-term value creation. Operating efficiency remains a focus. Operating expense reached $427 million in Q3 2025, an 8% increase from the prior year quarter. Management attributes this to scaling infrastructure to support the large receivable growth and continued strategic investments. While expenses are rising, if revenue growth continues to outpace this expense growth, the company should realize positive operating leverage, driving further profitability gains in subsequent periods. These strategic investments, such as automation and technology integration, are intended to yield disproportionately higher revenue growth in the future. Balance sheet assessment, asset quality, and capital structure. The balance sheet reflects OMF's status as a highly capital-intensive finance company with a dominant asset base and a specialized, heavily secured funding structure. Asset base and portfolio quality. As of September 30, 2025, the company's primary asset, net finance receivables after reserves, stood at $24.465 billion. Total assets were $26.985 billion. The overall quality of this asset base showed measurable improvement year over year, aligning with the observed reduction in net charge-offs discussed previously. Specifically, the 30-plus days delinquency ratio stood at 5.55% in Q3 2025 compared to 5.63% in Q3 2024, and the 90-plus days delinquency ratio decreased from 2.49% to 2.35% over the same period. These metrics collectively indicate that the overall credit quality of the underlying loan portfolio is currently strengthening. Funding structure and debt management. OMF utilizes substantial leverage to finance its high-yielding assets. Long-term debt totaled $22.338 billion as of Q3 2025, representing approximately 82.8% of total assets. The funding profile is defined by its reliance on secured capital markets facilities, with 54% of the principal debt balances outstanding being secured. While this provides access to substantial liquidity, it exposes the firm to refinancing risk and higher interest expenses compared to deposit-funded institutions. This reliance on structured funding is the key deficiency the ILC charter is designed to fix. A successful transition to deposit funding would dramatically enhance financial stability by lowering the reliance on credit-sensitive wholesale markets. Capital and liquidity profile. Total shareholders' equity provided a capital buffer of $3.378 billion as of Q3 2025. This supported a book value per basic share of $28.53. For sophisticated analysis of loss absorption capacity, the focus often shifts to the non-GAAP metric of adjusted tangible common equity, which excludes intangible assets like goodwill. ATCE stood at $1.839 billion in Q3 2025. Using ATCE provides a more reliable measure of capital available to absorb losses in a stress scenario, reflecting a more conservative view of capital strength. Despite the high debt-to-asset ratio, OMF maintains a robust liquidity position. Cash and cash equivalents totaled $658 million, although $251 million of this amount is restricted for regulated insurance subsidiaries and unavailable for general corporate use. Crucially, OMF possesses substantial latent liquidity resources. This includes $1.1 billion of undrawn committed capacity from an unsecured corporate revolver and $6.4 billion from revolving conduit facilities and credit card variable funding notes. Most significantly, the company holds $10.9 billion in unencumbered receivables. This massive pool of unencumbered assets acts as a powerful mitigant against potential funding shocks, providing ready collateralization potential and significantly enhancing the firm's financial flexibility should ABS markets tighten. This ratio of unencumbered assets relative to total receivables is a critical measure of funding resilience for a non-bank financial institution. Cash flow and capital allocation strategy. The business model of a finance company like OMF inherently consumes cash to grow its primary asset base, finance receivables.
Operating cash flow is continuously cycled back into funding new loan originations to achieve the aggressive growth target of managed receivables. The high debt load of over $22 billion confirms that internally generated cash flow is not sufficient to cover both the accelerating portfolio growth and the firm's significant capital return mandates. Shareholder return policy and confidence signaling. OMF's management defines its success based on capital generation, derived from C&I adjusted net income. The firm employs a dual strategy of dividends and share repurchases to maximize shareholder yield, reflecting strong confidence in the stability and future growth of this core earning power. The company recently reinforced this commitment by raising its quarterly dividend by 1% to $1.05 in Q3 2025. Furthermore, the board authorized a new substantial $1 billion share repurchase program set to expire at the end of 2028. This multi-year large-scale authorization, announced immediately following a period of strong earnings and credit improvement, serves as a powerful signal from the board. It implies that management views the stock as trading significantly below the intrinsic value implied by its internal capital generation models. Such an authorization would be unlikely if management anticipated a severe downturn in credit quality or a systemic funding crisis. The firm relies heavily on this high total yield, dividend plus buyback yield, to compensate institutional investors for bearing the cyclical risks and regulatory uncertainty associated with the non-prime sector. This structure is critical for managing the company's cost of equity capital. Dividend safety and sustainability analysis. OMF's dividend policy is a cornerstone of its investment profile, offering a highly attractive yield that stands at 6.82%. The sustainability of this payout must be assessed against its earnings coverage and the inherent volatility of the underlying credit portfolio. Coverage and payout ratios. The coverage remains healthy, indicating sustainability under current conditions. Based on the quarterly GAAP diluted EPS of $1.67 for Q3 2025 and the declared quarterly dividend of $1.05 per share, the GAAP payout ratio is approximately 62.9%. Historically, payout ratios have been conservative. For example, the ratio was 53.82% in 2022. The margin of safety appears even wider when coverage is assessed against the C&I adjusted EPS, the metric favored by management for defining capital generation, which stood at $1.90 for Q3 2025. The management team's explicit reliance on the non-GAAP adjusted net income suggests investors should primarily use this metric to gauge the capacity to fund the dividend, implying that earnings volatility from non-core operations should not jeopardize the payout.
Sensitivity to credit risk and funding constraints. Despite the robust coverage, the dividend's safety is directly tied to the highly cyclical nature of OMF's earnings. The principal threat is a sharp reversal of the positive credit trends observed in 2025. A severe and protracted macroeconomic downturn leading to a spike in net charge-offs well beyond the 8.12% NCO ratio seen in 2024 would necessitate dramatically higher provisions for losses, which would severely compress net income and consequently weaken coverage ratios. Furthermore, the dividend and the share repurchase program compete for capital against the continuous funding requirements of the growing receivables portfolio. Should external funding costs rise significantly due to higher interest rates, economic instability, or a downgrade of the company's debt ratings, management would be faced with the strategic dilemma of prioritizing either maintaining portfolio growth or sustaining the current high level of capital returns. Valuation framework and conclusion. OMF's current market valuation reflects a fundamental disconnect, placing a low multiple on near-term earnings while implicitly acknowledging the high underlying return on equity. A. Earnings multiples, PE analysis. OneMain Holdings trades at valuation multiples significantly below broader market averages. The trailing 12-month TTM non-GAAP PE stands at 9.6017, which declines further to a forecast non-GAAP PE F1 of 8.95x 17. This modest pricing contrasts sharply with the firm's recent earnings momentum. In comparison to specialized financial peers, OMF's valuation is consistent with other institutions heavily exposed to consumer credit risk.
For example, SLM trades at a TTM PE of 9.79x 17. However, OMF trades substantially below high-growth fintech lenders such as UPST, which maintains a TTM PE of 25.76x. B. Price-to-book value (PB) analysis. The current stock price of approximately $62.39, 18, when measured against the Q3 2025 book value per basic share of $28.53, results in an implied price-to-book (PB) ratio of approximately 2.19x. This valuation stands significantly above OMF's historical PB ratios, which were 0.67x in 2019 and 1.03x in 2022, though it has stabilized following a peak of 1.81x in 2024. The premium PB ratio is generally indicative of a high expected return on equity and market recognition of the quality and yield of OMF's assets. C. Growth-adjusted valuation (PEG ratio). The most compelling metric signaling potential undervaluation is the non-GAAP forward PEG ratio, which stands at 0.41x. A PEG ratio substantially below 1.0x indicates that the stock is priced cheaply relative to its estimated future earnings growth trajectory. This implies that the market is currently underpaying for OMF's anticipated growth. The coexistence of a high PB ratio, 2.19x, suggesting asset quality and strong ROE, and a low PE ratio, 8.95 forward, suggesting limited confidence in earnings durability, highlights a clear valuation disconnect. This discrepancy is best explained by the market imposing a cyclical risk premium. Investors recognize the quality of the high-yield assets, but demand a discount, low PE, due to the inherent volatility of earnings tied to the non-prime credit cycle. I. Conclusions. OneMain Holdings, Inc. is an institutionally scaled non-prime lender currently demonstrating financial resilience and effective credit management, even amidst broader signs of consumer financial stress. The Q3 2025 results confirm a favorable operating trajectory, marked by strong NII growth and a decline in realized credit losses, NCO ratio down to 6.67%. The balance sheet maintains robust liquidity, largely due to the $10.9 billion pool of unencumbered receivables. The investment proposition is strong, offering a rare blend of a deeply discounted growth valuation, PEG 0.41x, and a high well-covered dividend, 6.82% yield. Management's authorization of a $1 billion share repurchase program through 2028 provides further assurance regarding internal capital projections and commitment to capital returns. However, the realization of OMF's full intrinsic value depends on two highly sensitive variables. First, the company must successfully maintain its favorable credit trends and avoid a material spike in NCOs that would overwhelm its provisioning capacity. Second, and more importantly, the outcome of the ILC charter application represents the single largest variable determining the company's long-term cost structure and valuation multiple. A successful charter grant would stabilize funding costs, permanently boost NIM, and likely close the prevailing valuation gap between OMF and regulated financial institutions. A failure to secure the charter ensures the continuation of the current low PE multiple despite superior underlying earnings growth. The current valuation implies a sufficient margin of safety to warrant investment, provided that investors acknowledge the cyclical nature of the business and monitor the regulatory progress of the ILC application closely as the primary catalyst for significant future shareholder returns.